All-time highs, folks. Look at that. The S&P just closed at $7,500 a share. Wow. Congratulations to everyone who's invested in the market right now. I know you guys are experiencing amazing gains, and wow, what a time to be in the market. So over today's videos, we're going to go over how long is this going to go on for? Do we really think that the market's going to continue to go up? I keep seeing people talk about we're in for a historic bull run coming up. Do I really think that's going to happen? I'm going to go through some of the, cons that people aren't really talking about and just some factors to keep in mind. But, as always, before we get started, go sub, like, leave a comment. And let us know down below if you guys like the content and if you want to see any other stock videos in particularly, we'll end up covering those for you. And yeah, so let's get started. All right, so the S&P, man, just closed at 7,500. I mean, that's a huge deal. Look at this. It's up 27% over the past year. I mean, that's for an index, that's crazy. I mean, at this rate, wow, why would I even need to, invest in normal stocks? I could just put my money in here and voila, I'm going to make 30% a year. Like, sign me up for that. Year to date, we're up 9%. It's off to a better start than most years for the index. But man, do I think this is going to continue? Because people are talking about, we're going to the moon, we're going to keep hitting higher highs. So I wonder if we're going to go there. But we got a few factors to talk about before we get our hopes up in regards to that. So let's first talk about some of the elephants in the room here. Let's see, first, I'm gonna get some of this. All right, there we go. So, first off, CPI came in a few days ago, and it's not looking good for that. CPI came in at 3.8% in April, which is the highest since May of 2023. That's terrible. I mean, over 3 years, we just got the highest CPI in 3 years. That's not great. A lot of sectors were pushed higher. Energy, in particular, with both PPI and CPI, rose substantially. So, as you can see here, this is the most recent report, April 26th, and wow, that's definitely higher than normal. So. It's not great to see. This is a huge inflationary sign for us that we might be heading towards a recession because we have a lot of inflationary tells, and that will tell us if we're either heading towards a recession or more prone to hitting one or increasing our risks for that. And it also increases our risk for, let's call it a stagnant market, which is where it kind of doesn't go up nor down. It kind of trades sideways. And this is a direct effect and variable from stagflation, which involves having high inflation first, also involves low GDP and increased unemployment. But I don't need to get into that because I don't think we're gonna hit a scenario like that. But this is not good at all for the economy and especially for inflation. So let's also go here. So this just doesn't do this every time. But all right, so PPI also was reported yesterday, and PPI rose to 6% year over year, and for core PPI, it increased to 5.2%. And that is the highest PPI we've had in 3 years, and the highest core PPI we've had in 3.5 years. Now, just like CPI, these are not a good sign. And these two go hand in hand with inflation. For anyone who doesn't know the difference between CPI and PPI, PPI is the producer price index. I talked about this a little bit in a short the other day, but if you didn't get to check that out, PPI pretty much entails all of the production behind a product and the increased pricing with that. So, like wholesalers, distributors, retailers, and supply chains, those would all be considered PPI. And how that would work, let's say in a system, would be, let's call it eggs, for example. If you're going to buy eggs for $4, well, inflation gets high, let's say PPI and CPI both increase. So the PPI is for the producing from the wholesaler, and the will increase. And then when it gets to the retailer, that price is inflated. And now consumers have to come in and buy those eggs from instead of $4 to 4.50. And that is why CPI, this consumer price index, what the price the consumer is paying for is increased and inflated to 4.50, let's call it. So that is pretty much inflation, CPI and PPI, which is the highest it's been in over 3 years, which tells you where we are with inflation right now. And stuff starts to not get affordable, and it costs a lot of external problems to consumers and the overall market. So let's go over a few other things because those are just a few underlying variables, and I'll touch on that real quick before I move on. If inflation's bad, it's not going to go unpunished, let's say. Just because a market is doing good and indexes are flying and all the AI sector, all of the AI sector is going crazy right now, does not mean that we can ignore inflation, can ignore that the other half of the market is actually not doing good right now. If you look at a lot of the consumer staple stocks, like a Nike, like Celsius, like any of like the main staples that consumers often buy from, like a Lululemon, like just the typical stuff you would see at a mall, things that an average person would buy, those companies are tanking right now. And that's not a good sign. And people want to act like inflation can happen and the market can still go up. No, that's not the case. If we have such bad numbers, we're going to be affected eventually. Like eventually it's going to catch up to us and we're going to end up having to. All right, so sorry about that. Like I was saying, uh inflation does not go unpunished. A lot of people here think, wow, well, if we can ignore this, no, it's going to catch up sooner rather than later. And I personally think it's going to end up catching up next year because it's going to affect the market substantially, I would say. A lot of people think you can just ignore it, but you can't. This is going to be prevalent in the society and economy, and that's going to play a huge role in the actual stock market itself. There's a few things that can happen to alleviate that, which I'm going to talk about later in this video. But yeah, for now, that's not a great sign. But let's go through and talk a little bit more about a few other things. Okay, so this is the fear and greed index. Generally, a good rule of thumb would be anything in the 0 to 20. When people are super fearful, you want to do the opposite of. So you actually want to be buying. And now, if everyone and their grandma and their mom wants to buy everything and it's at 100, it means you want to start to sell, maybe load up a few hedges, kind of protect yourself because now we're getting to some overvalued state of the market. And this measures how fearful versus greedy someone is in the market. Extreme fear is no one wants to buy. Extreme greed is every single person wants to buy. Right now, we're sitting at a 66, and we actually just not long ago was in the 0 to 25 range. So that tells you people are getting really bullish. That means a lot of people want to buy back into the market now. They see the highs, their fear of missing out. They want to come back in, and that is kind of a bad sign for us, honestly, because you do not want to see everyone start to want to be in here, or else we get some valuation problems. So that's just what it is right now. We'll have to keep monitoring it, but it's it's neither great nor bad, but it's kind of getting into that dangerous level. We'll just have to keep an eye on it. Okay, so now what you're looking at here. Let me try. Okay. Now what you're looking at here is the AAI Michigan Investor Sentiment. So this is similar to the Fear and Greed Index, except it says how many people are bullish, neutral, or bearish. And now these are the historical averages. 37.5 percent are bullish, 31.5% are neutral, and about 31% are bearish. Similar to the fear and greed index, you want to see the opposite. You really want to see a high bearishness to give you more confidence in the direction of the market. So if it was 50% bearish, but the market is still moving up, that's telling you, wow, we still have a lot of room to grow because we're already moving up, but we still have, 20% of people to the to get back to historical averages to flip over to bullish in order for it to be just a historical average, not even a great time period, And for people, but for the market to already be moving up and then you switch over to that means there's still a lot of room for growth. So this just came out yesterday, 513. We're at 39% bullish. It actually was a lot more bearish recently. So that, that correlates with the fear and greed index. People are getting more, out of their shell and excited to come in and invest in the market. So the historic average is 37, so we're just above that. That's not a bad sign, but it's not a great sign. Let's look at the bearishness. We're at 36% are still bearish. So that's a good sign if you want the market to move up. It means there's still about 5% of people to get back to the historical average that would have to switch over to the bullish side. And that means, we got some room to grow, and people are generally more bullish right now than they are bearish. I guess that's where the sentiment is. People are just getting more happy to invest right now rather than scared and fearful. So we've checked those out. Those are kind of, good signs as well, just to monitor and see with the state. But look at this. This is more inflationary tells. This is the WTI, and this has to do with crude oil. So we want to see oil and commodities down for inflation to not be. Of course, we all know about the war, and I'll touch on that in a second. But right now, we're sitting at $100, pretty much 98 a barrel of crude oil. That is, that's terrible. That's compared to, let's see what a year ago. A year ago is down here at $62 a barrel. And down here is 55, which is a very healthy level. Seeing it go up to 100 and 105 and even 112 back in March is not good to see. We don't want to see crude oil prices double. That's a very inflationary tell, and that is not good for the overall market, despite the direction we're moving right now in the market. I just want to make sure people understand that just because the market is moving a certain direction doesn't mean external pressures have caught up yet at all. All this stuff takes time to play out. And let's be honest, like whenever you're investing, all you're checking sometimes is if it goes up or down, and some people tend to read it on a day-to-day basis when it's not a short-term game. It's a very long-term game. Pressures and effects and things that go into effect from the presidency and Fed all take years. That's why there's stuff called like the Fed lags, which is where the Federal Reserve cuts or raises rates, and that in turn takes years for the effects to actually hit us. It doesn't just hit tomorrow, you know, it's a lag. It takes a while. And that's the same with inflation, unemployment. It's the same with all certain metrics. It takes time to play out. This doesn't happen overnight. You'll see markets crash, you'll see housing crash, you'll see commodities and inflation go skyrocket, and then you'll see the market. It'll be a whole scaled out kind of domino effect. It'll be like, okay, the housing market's crashed. Oh, now the commodities are spiking. Oh, now you got treasuries and bonds crashing. And then you finally get the market to reciprocate that. So it takes a while. I just want people to look at this as a long-term game. It's not necessarily a short-term game. I know it looks like we just hit all-time highs, and I'm so happy for that. That's great. It's making us money, but we got to be aware of the risks if we want to be consistent investors in this game. So, with that being said, let's look at the crude oil's counterpart, commodities. So, this right here is pretty much a future ETF measuring out the commodities and measuring out the pricing for commodities. So, a rule of thumb here is you pretty much want to sit at 20s, 23, kind of what it was like. Look at a year ago. Kind of just sits here and does nothing. I'm not I don't have this saved for any like, oh, I wanna it's a play for me to make money. No, this is a huge inflationary indicator I have that I use. So this is a year ago, pretty much sat here in the 23s, 22s. That's a great sign. And that's why last year, coming out of that Liberation Day fiasco we had going in April 7th, that's why this stayed low. We had no inflation fears, and the markets just took off for the rest of the year and, till now. But look at this year to date went from 23 all the way to $34, up 50% a year. That's terrible. That's showing us that we have a huge issue right now with inflation. I mean, I've already talked about a few signs, but look at that. We've talked about crude oil's already skyrocketing, commodity prices are skyrocketing, PPI, CPI highest in 3 years, 3.5 years. That's a problem. Fear and greed index is starting to turn, which means sentiment's going good, which means we kind of want to back off a little bit. And investor sentiment is also showing us the same signs. So overall, we have few issues to keep in mind because these prices should not be here. I know someone might watch this and be like, why is that really a big deal? I mean, a few inflated prices are up. That's not good for the overall market, and they're going to feel its effects because inflation raises the risks of a recession because of a rate hike cycle that they're going to have to go in and do, and that's going to increase volatility in the market. So people don't want to see high inflation because it causes a whole bunch of problems. And in the overall market, if inflation is in the economy, that could also lead to higher unemployment because for them to raise height, have a federal funds raise height cycle, it means that they're going to have to raise rates. And that's going to incentivize employers to release and cut employees because of higher rates. It's going to make consumer yields harder to get loans on and mortgage rates because they're much higher. So it's a way to offset inflation. And that's a problem that we don't want to end up having. We're probably going to have to do that because of all the numbers I've been showing you. But if that happens, it means the market's going to go down a lot. It means rates are going to go higher, so people can't spend more and don't have easy access to loans. So, although it looks good right now, if we end up having this, it's going to be a negative effect for the entire economy. And you're going to see that coming next year. So, I mean, we'll see how it plays out. I really hope they start to alleviate this right now because we cannot afford to have, I mean, we can afford to have it, but it's just going to cause a huge headache. And depending on if we have a hard or soft landing when we come out of this, oh, it's just a mess. I hate when we go through times like this. But let's look at a few other things. All right, so let's okay, so right here, this is the Fed funds rate. This is what I was just talking about, whether the federal government and Fed chair would have to raise or decrease rates. Now, if we're talking about inflation, it would be smarter for them to have a Fed hike cycle. So they raise rates to offset the inflation, considering that that's pretty much the primary issue, I would say, right now in the economy. So right now it's at 3.6 as of March back in or in May, I mean, well, March of 26, but March back in 2024 was back at 5.3, which is why they needed to decrease it because at that point we had low inflation and low unemployment. So there was really no point to keep Fed funds rates high. You see what I'm saying? We didn't have any sort of reason to keep those rates high. It was just hurting the overall economy because we already had virtually no inflation, which is why they decided to cut it, and that was the smart thing to do. But now at this point in time, we got to consider raising it because, like I showed you, we're kind of getting into dangerous territory. And like I was saying, that I was going to talk a little bit about the war. It doesn't look like we're going to have a huge, it doesn't look like we're making a deal yet. I don't need to talk too much about this, but Trump says Iran must make deal or face renewed attacks. Honestly, I'm going to stay out of this. I don't need to talk too much about it, but we should just make that deal already. This has just been dragged on and drawn out for way too long. This is hurting the overall economy and market. As you can see, if we didn't have this problem, oil prices wouldn't be so high, and inflation and would also not be as high necessarily. It could also be from other factors, but this is definitely a primary factor to all this. And obviously, all the AI stuff that's contributing to all the energy consumption and usage we've been using, all the data centers that they have to use to make these CPUs and GPUs are increasing it. So it's not just because of this war, but this needs to stop. For in terms of gas prices, I'm sure you guys are tired of going to the gas station right now and paying $5 right now for a gallon. Like, not good stuff. We don't want to see that. So hopefully he can just end this stuff soon. But this is what I think, honestly, that you guys should do right now with this kind of market. It's a very concerning market, but it's once again, it's still a long-term game. And this is all short-term stuff. This might affect us in a year, but I know the people watching this and anyone who's trying to invest for real is going to be invested for 5, 7, 10, 15, 20 years. And inflation comes and goes. That's just how I look at the market, and it's the truth. I mean, it'll be here today, but it's gone tomorrow. And it's honestly not a big deal. I don't get worried about it. I like to see prices of stocks diminish because it means I get to buy more for a cheaper cost basis. Let's say SoFi or Zeta or AMD, any of the ones we've talked about. Well, heck, I would want them to continue to go lower so I could just buy a lot more for a lower cost basis. So there's good and bad stuff. This is all short-term stuff just to know what's going on in the economy. But I personally look long term, and I'm not really scared of any of this stuff because I know I can always invest more if the market goes down, and I'll come out making a lot more money. With that being said, this is what I'd recommend doing. I'd hold 20% cash, because this might happen in a year. And if this happens, you can deploy a lot more money into those big stocks that you might want for a huge discount. Let's say you like AMD right now, it's at 450. Let's say this happened, this played out, we had a 20% recession. AMD could go back down to $200. And let's say you had 20% cash. Okay, I want to buy into AMD. Boom, buy all your shares at $200, get another steal, and then leaving this recession, it could go right back up to 450 overnight, and you just doubled your money again. So that's a huge play that you could do. There's a lot of consumer staples, like I was saying, that are at a discount right now. You can honestly deploy money into that. I made a video last night about Elf. That's another one that's been beaten down. You could put money in there. Yeah, so hold some cash right now. Definitely have some because there are going to be huge buying opportunities, if not already, which there definitely is, but there will be even more discounts, I think, in a year. So I would hold on to cash for sure. Second one I would do is keep positions diversified. Continue to have the three sections that should make up your portfolio: the growth, value, and dividend stocks. Continue to hold. That's a main thing, too. I see a lot of people trying to time the market. Really, you should not worry about timing the market and worry about the time in the market, if you know what I'm saying. You shouldn't worry about timing whether you get in or out on time. You should worry about how much time you're at physical market. It's not a guessing game. It's buy it at a very cheap valuation that you believe you're going to return very well coming out of it over the next coming years, and just worry about the next opportunity. Do not try and sell it, even if we have a 20% correction or a recession next year. I'm not going to sell any of my positions unless I feel like they're overvalued. Like I feel like they're at the end of their stage. If they're like at a discount and still undervalued, I'm holding on to that. I don't care if I go down a little bit because I know coming out of it, I'm going to make a lot. And I don't know when the end of that is. If I knew the end, okay, wow, maybe I could guess it, but I don't know the end. None of us know the end. It just flips one day, and it could flip really high, like a V-shaped recovery. And if you're late and you try and time it and you're off by 2 days, you just missed 20% in 2 days. And now what are you going to tell yourself? You have to buy AMD at 250 instead of 200. You're going to be upset. It's no problem, but Keep your positions diversified. Do not sell and try and time the market. It is not going to work. It's a headache. It just takes too much time, and it's honestly, you lose money doing that. And lastly, I would recommend, if you want to, is to buy 1% of your portfolio for a hedge. So a hedge is basically an insurance. It's, in lack of a better term, betting, or not, it's not betting, but it's thinking that the market's going to go down. So, like I've been saying, this could cause the market to go down next year or even the end of this year, which I still think it's going to run up until midterms, which is the end of this year, and then start to kind of get iffy next year. So a hedge is thinking it's going to go down. So let's say I thought Target stock was going to go down because of this, and Target's going to get hit hard by inflation, so they're going to tank when the market tanks. I would buy put options uh, and contracts on Target, and almost I would make money as they go down, pretty essentially. So I could buy 1% of my portfolio for put options on Target. And as my portfolio is getting killed because the whole market's going down, that Target put option is actually making me money and kind of alleviating the damage I'm getting in my portfolio. Kind of like insurance, if you want to look at it like that. So it's an insurance play. It's like, okay, I could do $1,000 as a put contract. If it works out, I make a lot of money from that, and it actually offsets it, and I come out losing no money. But if the market continues to run and I end up having that put option expire worthless to zero because it didn't work and I lost $1,000, I would make way more than $1,000 coming out because it is continuing to go up. So my contracts expire worthless, but my assets that I already own are appreciating so much that they counter the money I just lost. It's kind of like insurance. You buy insurance anyway. You might not have to use it, but you buy it anyway. You could lose all of it, but it's kind of there to for safety. So that's another play you could do, which I've done before. It works out if you do the right hedges. If you do the wrong one, it's kind of it's not great, but that's more research you got to do. So that's what I recommend doing right now, and that's the overall state of the economy and all this inflation. So honestly, we're in rough times, but right now it's really good. With the market and look at the S&P hitting all-time highs. It's going to be, interesting to see what happens, but just remember that this inflation stuff is not going to go unpunished. Don't don't be naive and think it's just going to keep going up, because all the points I showed you are definitely things to keep your eye on for this year and up until next year. So if you guys like the video, leave a like I said, leave a comment, subscribe to us, and yeah, I'll catch you guys all in the next one.